The Mining News Select Conference will be held in Perth on the 17th and 18th of June, and it's promising to feature some of the best under-the-radar resource companies working in the critical minerals and gold space. Sprott Wealth Management founder Rick Rule will be addressing the conference online from Washington State, but he's joining me today for a preview, so welcome, Rick.
A pleasure to be with you. Thank you for having me.
Now, most resources investors would have heard of Eric Sprott, and you're the largest shareholder of the Sprott holding company. Do you two go back a long way?
Eric and I have been friends and friendly competitors for probably 3 decades, maybe a little more, a very long time.
So tell us about your investing work.
Well, I've been principally involved in natural resource investing and natural resource finance for 50 years. A consequence, I guess, of being involved in natural resource finance is I've also become a financial services industry investor, which is to say, investing in banks, wealth managers, asset managers, insurance companies. But I'm probably best known to the Australian audiences for my work in natural resource companies, including fairly small exploration companies. I began, as an example, investing in Australian equities probably 40 years ago when many North American natural resource investors couldn't spell Australia.
To go down that line of investing in exploration small caps, that's risky business, right?
Well, it is true, as you say, that it's a risky business. It's also a business where the distribution of information is inefficient. And if you are willing to work harder than your competitors, you can outcompete them. Information is better distributed in large cap companies. So the return to effort relative to your competitors is much higher in smaller companies. That's one of the reasons why I was attracted to the small cap space.
If you get it right.
Yes, if you get it right. I mean, it's a function of work. What I have found, people describe speculators such as myself and Eric Sprott as being lucky. The truth is that the harder we work, the smarter we work, the luckier we get.
Can you let us in on a secret or two around the strategy that you, Eric, and the rest of the team have employed?
I would say that there's 4 things that set us apart from many speculators. The first is that we don't follow the maxim, got a hunch, bet a bunch. We do a lot of work on geology. We do a lot of work on financials. We do very deep dives into these companies. None of us own more stocks than we can adequately research at any point in time. That's very different than many retail investors. I would say that our successes, both of our successes, are due to the fact that we're contrarian investors. We try to come into sectors when they are out of favor, not in favor. We both came into the uranium sector in 1999 and 2000, respectively, and then again in 2022 and 2023, when uranium was decidedly out of favor. Now that uranium is back in favor, everybody is crowding into a sector where the price is up 4-fold. The idea that you learn to love hate as a speculator, that you become a contrarian, has been instrumental to the success of most speculators in natural resources I know. The third factor I would suggest is that we're patient. Many small cap investors would like results, quantum results, to occur, quickly, but they don't. The real wonder of the financial world is compounding, and compounding takes time. Even in exploration, it's a process of answering an unanswered question. Every successful answer poses a new question. So in my experience, as an example, those times when I've enjoyed 10-fold returns or 20-fold returns or 50-fold returns frequently have taken 5 years or 6 years or 7 years to occur. Most speculators have time frames that are measured in weeks or months, not in years. One must also be tenacious. In most of the 10-baggers, the 10-fold returns that I've been lucky enough to participate in, the share prices declined by 50% or more during some period of time that I owned the stock. So I had to be certain enough about my thesis that I could withstand psychologically and financially a 50% share price decline on the road to 1,000% or 2,000% gain. The fifth thing, I think, is that you learn over time in speculation that probably the most important factor is the human factor. There is a small group of people in mineral exploration and mine finance that generate almost all of the value. Your ability to identify those serially successful people and establish relationships with them so that you can get involved in their transactions early on, and also the discipline to avoid less successful or unsuccessful people, irrespective of how compelling their story is a very important attribute. When I look back to the entrepreneurs that I had the ability to do business with, even back in my 20s. The Lundin family would be an example. In your country, Robert de Crepney. There's a fairly small group of people who have really accounted for 70 or 80% of my success. So I would suggest that those are the factors: a contrarian nature, the willingness to work, patience, tenacity, which is different than patience, and the discipline to only do business with truly outstanding counterparties.
You've touched on your commodity strategy there. So now that uranium's running hot, what will be your next commodity target?
I don't have a commodity-centric target for today. The most recent one in the past was coal, which was as out of favor as uranium. The coal thesis has begun to play out. I'm very, very attracted to North American natural gas, although that might not be attractive to Australian speculators, but it represents a real value opportunity in the market. I would say that if I were able to acquire non-South African, non-Russian platinum and palladium assets, that would be attractive to me. Platinum and palladium prices are way off. The narrative around platinum and palladium is that its use as an auto catalyst will go away because the internal combustion is going to go away, which I think is foolishness. And platinum and palladium is produced principally in South Africa and Russia, with a bit of an overlay in Zimbabwe. South Africa is a basket case. Zimbabwe aspires to be a basket case. And Russia, as unstable as it is the most stable of the lot. If you saw overwhelming social difficulties in any of those countries, it would be easy to see 30 or 35% supply declines in platinum and palladium, and it would be easy to see the price double. And if the price doubled, interestingly, I don't think it would have much impact on demand, in the sense that $100 worth of platinum in a catalytic converter enables the sale of a $50,000 or $60,000 car. If the platinum price doubled, it wouldn't change the shelf price of the product that the platinum goes into. So I like that. Looking further forward, Sonia, I suspect 2026 or 2027 that I'll be coming into the lithium place. Lithium was, of course, the flavor of the month. It attracted hundreds of thousands of adherents to the narrative. There is no hate as sincere as the hate of a jilted lover. And with several 100,000 people experiencing jilted love around lithium, I would expect that the market will continue to be in oversupply for a couple of years. And I would suspect that lithium would be regarded by speculators in 2026 or 2027 as a four-letter word. When it's hated, I'll be there.
So what do you intend to share with investors at the Mining News Select Conference in Perth?
The value of the Mining Journal Select Conference is that the entire human resource of the Mining Journal is dedicated to finding the 150 best out of 300, or pardon me, 3,000 worldwide, to allow you to search from among the best of the best, having already had them dispose of 2,850 out of 3,000 aspirants worldwide. That's an extremely useful process. The other thing that the Mining Journal Select does is they select companies in a very non-ethnocentric way. They expose Australian investors to North American opportunities and European opportunities. Similarly, they expose North American investors to Australian opportunities. The idea, the franchise, or the platform that the Mining Journal has allows them to look at 3,000 mining companies around the world without being jurisdiction centric, like, say, an Australian investment bank might be if they weren't receiving fees from a North American issuer. I think that's extremely valuable.
Now, Canada's just cut its interest rates. And of course, we've been in an environment that's inflationary, and it's been difficult in recent times for some ASX listed companies to raise capital. Considering the rates move in Canada, do you see that trickling down to Australia? And how do you view access to capital moving forward?
Well, I would suggest that the problem with capital, and this will probably be not well regarded by your listeners, I would suggest that capital has been tight because capital has been misused by the mining sector in the past. If you look at 3,000 juniors worldwide, I would suggest that fully 2,700 of them are valueless, have no value whatsoever. I notice that in my own investing, that at least for the last 18 months, the financings that I have wanted to participate in have been uniformly oversubscribed. So I would argue that capital hasn't been tight. I would argue, too, that in Canada, at least, in the last 90 days, capital has been much more available. So I would dispute the fact that rationally applied capital has been tight. I do believe that the decrease in the interest rate in Canada will signal to Canadian investors that the Canadian government has decided not to be vigilant in the fight against inflation. What that likely means is that there will be increasing sentiment in Canada towards natural resource investments, particularly precious metals investments, which are regarded as inflation hedges. To the extent that that narrative takes hold in Canada and in the United States, it may trickle over to Australia. I don't know enough about domestic Australian politics to tell you whether or not the Australians would lower their interest rates, either given the incentive or more cynically given the excuse of an interest rate cut by their Canadian counterparties. My own suspicion is in the intermediate term, the 3 to 5 year time frame, that the interest rate cuts will be less important to natural resource investors than increasing margins associated with commodities that I think inevitably will see commodity price increases.
Obviously, so many of us try our luck in investing and can unwittingly have a bit of a gambling attitude toward it. What would your key message be to investors today and those going to events such as the Mining News Select Conference this month?
Well, I think in the context of this conference, the fact that the Mining Journal has pre-screened the opportunities is especially important. You need to develop your own filter or your own filters. In other words, you need to pay attention to the opportunities that they have drawn to you in your own context. I'll tell you one other thing, Sonia, though, that I think is very important. There's a belief in a conference that all the knowledge in the dais, or in the conference, pardon me, emanates from the dais out to the audience. And that's ridiculous. The Mining Journal Select Conference is going to have 400 or 500 seasoned mining investors. So while you're there, by all means, pay attention to the speakers, but pay attention too to the people that you meet at the bar, at lunch, around the coffee. There's lots of expertise there. When you sidle up to a booth, pay attention to the questions that are asked by the person before you and the person after you. One of the lovely things about the Mining Journal Conference is that many of the panelists, many of the speakers, enjoy the conference as well. The idea that you can tag along a couple industry experts after they get off the dais and wander around the exhibit hall and observe what exhibitors they sidle up to, what exhibitors they ask questions of, can be extremely instructive.
Now, before we go, Rick, can you tell us about your shirt? Because I confess that I haven't heard of the Battle Bank before.
I'm celebrating retirement by starting a new bank. This is now my seventh. And I've learned that one of my competitive advantages is, because I'm fairly well known, being well known lowers my customer acquisition cost. This bank isn't even open yet, and there are 14,000 people on the waiting list to do business with us. I note as an example that interactive brokers would pay me, were I willing to accept it, a tenth of a cent per impression for internet-based impressions. and I generate something like 250,000 impressions a week. So if those impressions can accrue to the benefit of Battle Bank and lower my customer acquisition cost, I can pay higher deposit rates while still generating excellent returns for shareholders. That's what I do.
Rick Rule, great to see you today. Thank you so much for your insights. Hot Copper and the Market Online will be covering the event. And again, that's June 17th and 18th at the Pan Pacific Hotel in Perth. Thank you.
A pleasure. Thank you.